Hello everyone. In today's session, we are going to deal with one very important topic in accounting for materials known as pricing of materials. So in the last classes, we discussed that there are three basic steps which are involved in accounting for materials. One is purchase control. The other one is stores control. And the third one is pricing of materials. So in the last two classes, we discussed about purchase control and stores control. Today we are going to discuss in specific about pricing of materials. Now what do you exactly mean by pricing of materials? Now when you listen to this class, you should think from the point of view of a costing clerk or a cost accountant, not from the point of view of a customer. Now imagine that you are a costing clerk or a stores manager, and on Friday you bought 10 units of raw materials at rupees 1, and then on Saturday you bought 15 units of your raw materials at rupees 2. So these are two lots of stocks which you have purchased in the last week. Now on Monday, your production department demands 10 units for production. So the production department has asked you to issue 10 units from the stores so that it can start its production. Now the question is, so in your warehouse you have two lots of raw materials. These are the same raw materials which you purchased on 2 different days at 2 different rates. So now the question is, on Monday when the production department is asking you to issue 10 units so that they can start their production work, the question before you is, from which lot are you going to take these 10 units? Are you going to take it from the lot that you purchased on Friday, or are you going to purchase it from the lot that you purchased on Saturday? This is the question before the cost accountant. Now, pricing of materials answers this particular question. It tells you from which lot you have to take your materials for production. Now, there are different methods which we use for pricing of materials. The first method is actual cost method. Second one is average cost method. So these are the two major types of pricing of materials. So I repeat, what is pricing of materials? By pricing of materials, we mean the price at which the costing department issues the raw materials to the production department. So in this example, if the costing clerk is going to issue from the first lot, that is from this lot, the lot purchased on Friday, then these 10 units will be issued at 1 rupee per unit. On the other hand, if the costing clerk is going to issue these 10 units to the production department from the second lot, then the price per unit is rupee 2 per unit. So depending upon the type of method which we are going to use, or the method which we use for pricing of materials, this cost will differ. Now why is pricing important? Because pricing answers you what is the cost of materials which have entered into production. So based on the pricing of materials method, your cost of materials for the production will also change. So these are the two basic methods which we will be discussing, and in these you have some 2 to 3 methods in each of these, in actual cost and in average cost method. So we are going to start with the actual cost method. Now we will discuss what are the different types of pricing of materials which are used. So we said that there are basically 2 different types. One is actual cost methods, and then we have average cost method. In actual cost method, we have FIFO, some say it's FIFO, some call it FIFO. Then we have LIFO, HIFO, and base stock method. In average cost method, we have simple average method, we have weighted average method, we have moving simple average, and moving weighted average methods. So these are the different methods which we have in pricing of materials. So this means first in, first out. If LIFO is last in, first out. HIFO is highest in, first out. And the last one is base stock method. So as per our curriculum, we have to learn FIFO, LIFO, simple average and weighted average method. So today we are going to discuss the average cost method, and in average cost method we are going to specifically discuss about the first in first out method of pricing, also known as FIFO or FIFO, you can call it as you want. We normally call it as FIFO. If you refer to certain YouTube channels, they refer it to as FIFO. So anyway, so we'll be dealing with FIFO method in particular today. So FIFO, it is first in, first out. So here the concept is whatever material which we purchase first, or whatever materials comes into our stores first, that will be the material that is issued first. That is the meaning of first in, first out. So as I told you, in the stores department, we purchase materials daily. So if yours is an organization which has continuous production, we will have to buy materials at regular intervals. So maybe even in a day, you will have to buy 2 or 3 lots. So maybe in certain cases, every single day you will have to make a purchase. Depending upon the volume of your production, how much you purchase and the frequency at which you purchase differs. In either case, whatever is your frequency, first in, first out method says that whatever you purchase first, that will have to be issued first to production. So if you have 2 lots, the first lot 10 units were bought at ₹1, and then on other day and on the next day you're buying 15 units at ₹2, then the first in first out method says that if your production department is asking you for 8 units, so the production department says that it wants 8 units for production. According to the first in first out method, so this is the lot which came in first, so this is the lot which should go out first. So you have to take 10 units out, 8 units, sorry, 8 units which the production department asked us for. So you will have to issue these 8 units from the first lot that was purchased. So from this lot, you are going to issue the 8 units to the production department at ₹1. And then you will have, and then the next time when the production department asks for units or for raw materials, say they are asking for 5 more units. So on the next day, the production department wants 5 units for production. So we know that we have taken 8 units from the first lot, which means we have remaining only 2 units. So the first in first out method says that you have to take 2 units from this slot at ₹1 and then 3 units from the next slot. That means that first in first out says that whenever the production department asks for materials, or whenever the production department wants an issue of materials from the stores, you have to take the materials from the first lot, then finish the first lot or exhaust the first lot, and only then can you take materials from the second lot. That is what the first in first out method says. So now we will look at how the store's ledger is prepared by the costing department in the case of FIFO. So in every method, we do prepare something known as a store's ledger account. That is, the costing department will prepare something known as stores ledger. So we had discussed this in the other class. Stores ledger actually tells you the number of units that have been issued from the stores to the production department and the rate at which it was issued. So it tells you the number of units that was issued as well as the rate at which the materials have been issued from the stores to the production department. So this is what exactly the stores ledger tells you. Now why you prepare stores ledger is because at the end of the period, the stores ledger will give you a very clear picture as to what is the remaining number of units that are left in a particular period of time, or what is the closing stock of materials. If you want to know an idea, or if you want to have an idea about the closing stock materials in the stores, you can have a look at the stores ledger. So in all these cases, whichever is the pricing of materials which you use in your organization, the costing department will prepare a stores ledger account. Depending upon the method that you use, the value of your closing stock will differ. We look at that when we do each and every method, so you'll get a very clear idea about how the value of closing stock differs when we use each of these methods. The units of closing stock will remain the same, but the value of closing stock will differ when we use FIFO, LIFO or simple average or weighted average. Depending upon the method, the value of your closing stock is going to change. Now we'll have a look at how the stores ledger or how the mechanism of FIFO actually works in a real life scenario. So we'll do a practical problem now. Now we are going to see how stores ledger account is prepared under the first in first out method. So we've been given a problem here and the details are given for the month of January. So from January 1st to January 30. There are certain entries which we have to make in the stores ledger account. So this is the format of a stores ledger account. In the first column we show the date. Then we have three main columns. One is the receipts column, the other one is the issues column, and then the balance column. And in all the columns, what is common is units, rate and amount, the number of units which are received or issued and the balance. Then the rate and the amount. This is common in all the three major columns, that is in receipts, issues and balance. We have a units, rate and amount column. Now in the receipts column we have the first column is GR number, which is a goods requisition note number. Normally when we do problems, these details are not given, that is the GR number, and the MR number in the case of issues is not given. That happens when you are practically working in a stores or working in the costing department. That is when you enter the GR number and MR number. But when we prepare the stores ledger, we do mention these two columns, even though in most situations when you do the problems, the GR number and MR number columns will be a blank. So what exactly is a GR number? We did discuss this in the purchase procedure. GR number is goods requisition note number. That is, it tells you, that is when we place an order for buying certain number of units from the supplier, when the supplier supplies us the materials, we enter for the lot which we have received from the supplier, we do enter something known as a goods received note number. This is for identifying a particular lot of materials which has been issued, which we have received from the supplier. I repeat, when the supplier supplies us a specific lot of material, say 100 units at 5 rupees, we have received from supplier A. In order to identify that these are 100 units bought from supplier A, the purchase manager will enter something known as goods received note number. This is the number which we mention in the receipts column. And in the issues column, you have something similar to a goods received note number. We have MR number, which is known as material requisition number. That also we did mention in our purchase procedure. Material requisition number is every time the production department asks the stores department for issue of materials, in order to get the materials identified, to identify the materials both by the costing department as well as the production department, the stores department, whenever it makes an issue, when the production department, whenever it wants an issue from the stores, it will issue something known as material requisition note, in which the production department will very clearly say that require 400 units of material A on this particular date. That will be what is mentioned in the material requisition number. So, this material requisition number also acts as a number with which we identify a particular lot that has been issued by the stores department. So, these are two different columns which will be there in every stores ledger account, but as I said, in the case of in the problems which we do, normally the GR and MR number columns are left blank. So, this is the format for a stores ledger account. We have a receipts column, that is every time we purchase materials from our supplier, the entries are made in the receipt column. Every time we issue materials to the production department, we enter it in the issues column. Whatever is the balance, that will be entered in the balance column. So, here we are presented with a problem, and in that problem the details of the materials purchased and issued in the month of January 2020 have been mentioned. And they are saying that on 1st January, on 1/1/2020, it is said that 200 units were purchased at 2 rupee per unit. So, since we have purchased it from the supplier, we are receiving materials into the stores. So, it is shown in the receipt column, 200 units have been purchased at 2 rupee per unit. So, we have materials worth 400 rupees in our stores. And on that specific day, the production department has not asked us for any materials. So, on 1st January, we just have that one entry, we have just purchased 200 units at rupees 2. So, in our stores, we have materials worth 400 rupees. So, we have to show that in the balance column. The balance column will tell you how many materials at what price it was purchased is remaining in our store. So, we have to make the same entry here, 200 units at 2, 4, and then draw a line, something similar to closing an account. And then on 5th January, we are making another purchase of 300 units at 3 rupees per unit. So, since we are purchasing, again because we are purchasing, we are receiving materials into our stores, that is why it is entered in the receipts column. So, we have materials, we bought materials worth 900 into our stores. And on the same date, again we have no issues. Now, when we show it in the balance column, now we have two lots of materials. So, we have 200 units of materials purchased at 2 rupee per unit, which is 400, and then we have materials which we bought on 5th Jan, that is 300 units which we bought at 3 rupees per unit. So, materials worth 900, underline it. So, that means that as on 5th Jan 2020, we have, these are for the same materials, we have two lots of materials, one which was bought at rupee 2 per unit on 1st January, and then we have 300 units which were bought at 3 rupee per unit on 5th January. So, two different lots, two different quantities, two different unit prices bought on two separate dates. These two lots we have on stores, in our stores, sorry. Then on 10th January, we have an issue. So, the production department has asked us to issue 250 materials. So, here is where the pricing of materials principle comes into application. So, the production department has asked us to issue 250 materials, 250 units of materials from the stores. So, as I told you, the method that we are dealing with right now is first in, first out. So, the production department has asked us for 200 units. So, as per the first in, first out method, we have to issue the first lot first, this lot. So, we have to issue from the first lot first, but they have asked us for 250 units. In the first lot, there are only 200 units. So, we have to take all those 200 units first, finish it off, and then take from the second lot. So, that means on 10th Jan, so you don't have any purchase made on 10th Jan. So, you are going to issue 250 units, 200 units you are going to take from the first lot at 400, and then in total they have asked us for 250 units. So, you are going to take the remaining 50 units from the second lot at 3. So, this is, so you are issuing to the production department in two lots, you are issuing 200 units at 2 per unit, and then you are issuing 50 units taken from the second lot at 3 rupees per unit. So when you write the balance column on 10th Jan 2020, you have finished or you have exhausted the first lot. You have taken few units from the second lot. So from this 300 units, you have taken 50 units. So that leaves us with 250 units at rupee 3. So we have materials worth 250 units at rupee 3 and value is 1000, sorry, the value is 750. So you have materials worth 750 as on 10th Jan 2020. So that is how issues are shown in the first in first out method. Then again on 15th Jan, again you are purchasing 400 units at 4 per unit. So you have materials worth 1600 which have been freshly bought into your stores. On that same date you have no issues of materials. So the balance is 250 units at 750 and then the materials which were bought today 400 units at 1600. So on 15th January you have 2 lots now in your stores remaining, 250 units at 3 and 400 units at 4. Then again on the next day on 20th, your production department has asked you to issue 300 units. So so on that date there are no other purchases which have been made. There is an issue and they have asked us to issue 300 units. So again, as per the first in first out method, you have to start with the first lot. So you are going to issue all the 250 units at 3. So they have asked us in total for 300 units. You are going to take the remaining 50 from the second lot, 50 units at 4, 200. So you have 350 materials at 4 rupee per unit. So you have materials worth 1400 in your warehouse or in your stores. So again I repeat, they have asked us on 20th January, the production department has asked us for 300 units and these 300 units as per the first in first out method, you first issue from the first lot which is remaining in your stores, that is 250 units at 3. So the 250 units you have issued, they have asked us in total for 300. The remaining 50 you take from the second lot at 4 per unit. So the total value is 200. And so on that date the balance is, we've exhausted the first lot. We have only the second lot remaining. We have 350 units at rupees 4 remaining and the value is 1400. Then on 25th of January, again we have made a purchase of 500 units at 5 per unit. So we have materials worth 2500 in stores. On that day there are no other issues that have been made. So we have on that particular date we have in our stores 350 materials at 1400 rupees worth and 500 units at rupees 5, 2500. So on 25th Jan we have 2 lots, 350 units at 4 rupee per unit and 500 units at 5 rupee per unit because we have made a fresh purchase. Then on 30th Jan 2020, they have asked us for 600 units. The production department wants 600 units. Since it's the production department that is asking us for units, we have not made any purchase on that particular date. They have asked us for 600 units. So again, as per the first in first out method, you have to take first from the first lot 350 units at 4. So that means you have exhausted your first lot which was remaining in your stores on that particular day. And they've asked us for 600 units in total. We've given them 350 units from the first lot. That means we have to take 250 units from the second lot at 5. That is 1250. And that leaves us with 250 units at 5, 1250. So those are the details for the month of January. That means closing stock or stock on the end of January is we have in our stores 250 units at rupee 5 per unit, and we have materials worth rupees 1,250 in our stores. So that gives you the value of the closing stock as on 30th January 2020. So this is how we determine the closing stock of materials which are left in our stores on a particular date. So stores ledger will give you the complete details as to how many units were purchased at what price. You can look at the receipt column, that will give you the details, and how many units were issued to the production department, that will be given in your issues column. How many units were issued, at what price they were issued, from which lot they were taken. All these details you will get from the stores ledger. Now one other reason why the stores ledger is prepared is because when you look at the stores ledger, it gives you a clear idea about how many items of materials are remaining in your stores, what is the value of that particular item, of those items, and what is the price of unit or the rate of those particular items. Now why this is important is because this is the amount which we will show in our cost sheet as closing stock. So if you are preparing a cost sheet for the month of January in order to ascertain your profit from your operations, the amount which you show as closing stock will be this value. So stores ledger is very important. It gives you details about receipts and issues and the balance of materials lying in your stores, as well as it gives you the details about the closing stock of materials which are there in your stores. So this is the importance of stores ledger. Now from the practical point of view, as I said, your GR number and MR number normally remain blank because those details will not be given. And again here we are dealing with a very basic problem where on a particular date you either have only a receipt or an issue. This doesn't happen in a real life situation. On a single date you will have more than one receipts, you will have more than one issue which is happening. So on the same day itself you will have to show in the receipt column, close the balance column, and then show it in the issue on that particular same date itself. So those kind of things happen in a real life situation. Here we are dealing with a very basic problem of in FIFO. So this is how you arrive at closing stock in the first in first out method. So what we dealt with right now was a very simple version of a FIFO problem. In a real life situation, we do come across certain special transactions or certain adjustments when we deal with preparation of a stores ledger in real situations. So 4 type of adjustments which are common to all pricing methods are pricing of materials returned to stores, pricing of materials returned to vendor, shortage of materials, and surplus of materials. So these are 4 different kinds of adjustments or special transactions which do occur when we prepare stores ledger account. So let's look at the first one, pricing of materials returned to stores. What we have to remember here is who is returning materials to the store. So whenever the production department wants raw materials for carrying out the production activities, the production department asks the stores department for the raw materials. And whenever the production department asks for raw materials, we issue raw materials from the stores to the production department. But what happens many a times in real situations is that sometimes the production department would have asked for more number of units than what they actually require. For example, they asked us for 500 units, but they did not require 500 units for some reason, so they returned us back 50 units. So the production department has asked the stores department for 500 units of materials. So when the production department asks the stores department for materials, we show it in the issue column. But because of some reason, maybe because they could not finish the production on that particular day or because they could not start production on a particular day, they are going to return the 50 units that they had, they don't require, back to the stores department. So the production department now is returning to the stores department. Production department is returning to the stores department 50 units. So that is what is meant by pricing of materials returned to stores. The production department is returning the materials which it does not require for production on a particular date back to the stores department. So now you think from the stores manager's point of view, we are receiving materials from the production department back into the stores. So it will be shown in the receipt column. So this is shown in the receipt column. So always remember that whenever the production department returns materials which are not required by it for some reason, it will be shown in the receipt column. This is common across all methods. Now the question is, at what price are you going to show it? That is, when you show it in the receipt column, when you write the rate, at what rate are you going to show it? Now if the date is mentioned, if the production department tells you that they've say for example on 1st January you issued 500 units at 5, so 250 rupees. So this is the issues made. And on 8th January the production department is returning to us. So this is shown in the issue column because they've asked us for materials. The production department has asked us for materials for production. So we issued them 500 units at 5. Now on 8th January, they are returning to us 50 units which were issued from the units on 1st January, from the issue made on 1st January. If that particular date is mentioned, so this is a return, this is shown in the receipt column. This is shown in the receipt column. And if the date is mentioned, that is, if the production department is specifically saying that we are returning 50 units from the materials that were issued on 1st Jan, then we show it at rupees 5. If the date is not mentioned, that normally the date will be mentioned. If the date is not mentioned, then what we do is in the stores ledger on 1st January, we look at the balance column. So on 8th January, they are returning 50 units to us. So on 8th January, we will look at the balance column, and in the balance column, we will see how many lots are there, how many lots of materials are there. Say for example, on 8th January, you have 100 units at 1 and then you have 200 units at 2. Just assume that this is the lots which are available on 8th January. And then we are getting a return from the production department of 50 units. Then those 50 units, and the date is not mentioned as to from which lot is the returns coming. If that is not mentioned, then we will price this 50 units at the first lot's price. As per the first out method, we will issue at the oldest consignment's price. So pricing of materials returned to stores is shown in the receipt column. If the date is mentioned regarding it is from a particular date's issue that the returns are being made, then you go and look at that particular date, look at the price at which the materials were issued and price the returns on that rate. If the date is not mentioned, on the day in which the returns are made, you look at the balance column and then you see which is the first lot which is available there, and then you price it in the first lot's price according to the first in first out method. So that is pricing of materials returned to stores. The second adjustment is pricing of materials returned to vendor. Vendor is our supplier. If we feel that a part of our materials are not of the requisite quality, if it is substandard or if it is damaged, then whatever materials that we have, such materials which we bought from the supplier or from the vendor will have to be returned back to the supplier. So we've received 100 units and we find that from the supplier, and we find that 5 units out of the 100 units are damaged. So we'll have to return it to the vendor and ask for a replacement, or the case, whatever the case may be. So when we are returning the materials to the vendor or to the supplier, we have materials going out from our stores. So this is shown in the issues column. So when materials are returned to the vendor or to the supplier, it is shown in the issues column. The principle is the same. If the date is mentioned, if they say that we are returning materials out of the materials which we purchased on 1st Jan, if that date is mentioned, whatever is the rate of materials purchased on that date, you have to price the returns on that price. If the question is silent as to the date of the materials which were date of that particular purchase which was made from the vendor. Then again same, on the day in which the return is made, we look at the balance column, we see which is the first lot available there, and we price it in the first lot's price. So pricing of materials returned to stores is shown in the receipt column, pricing of materials returned to the vendor is shown in the issue column. Now we do have something towards the end of the a month, or depending on different organizations, sometimes they do have something known as a stock verification. They have stock counting, which happens in certain organizations at the end of a month, sometimes it happens at the end of a quarter, sometimes it happens at the end of a year. So what happens is the stock verifier comes to our stores and physically verifies or counts the number of materials which are available in our stores. So when the counting is made, so he will have the store's ledger with him, he will do a physical count of materials which are in the stores, and these two will be seen if they are matching or if they are tallying or not. Many times what happens is we will either have a shortage of materials or we will have a surplus of materials. So shortage of materials happens when in the store you have 10 units. So the stock verifier counted the number of units, and in the store he found that there are 10 units. But then in your store's ledger, it shows that on a particular date, on that particular date, on 30th Jan maybe, on 30th Jan when the stock verifier counted the actual number of units in the stores, he found that there are 10 units. So this is in the stores, and this is as it is shown in the ledger. This is on 30th Jan. Okay, so on 30th Jan there is a stock verification, and the stock verifier finds that in the stores there are actually 10 units there. But the ledger shows, the store's ledger shows that there are 12 units. So that means there is a shortage of units. So actually the ledger should have shown 10 units, but then the ledger shows 12 units. So we have to make a correction. Now how do you make that correction? So we have to reduce this 12 back to 10. So that means if we have to reduce the number of units in our stores, we have to show it in the issue column. So shortage of materials is shown in the issue column. That happens because your ledger shows a higher balance than what is actually available in your stores. So in order to make a correction, you show the shortage of materials in the issue column, and again the price at which it is shown according to the FIFO method. On 30th Jan you will look at your closing balance on in your balance column. You see the number of lots that are available, you see the first lot which is available, and then this shortage will be issued in the first lot's price. Then you have exactly opposite to shortage of materials, you have surplus of materials. So if the shortage is shown in the issue column, the surplus of materials is shown in the receipt column. So receipt column is an opposite situation where he has 12 units in the stores, but the ledger shows only 10 units. So on 30th January, the stock verifier counts the number of units which are available in the stores, and he finds 12 units. And then when he cross checks with the ledger, he sees that the ledger balance shows that there are only 10 units. So that means there is actually a surplus of stock which should have been entered in your ledger, but because of some mistake it was not entered. So we have to increase the ledger balance from 10 units to 12 units. So what we do is those 2 units we will show in the receipt column, which will increase our ledger balance from 10 units to 12 units. And the price again, in the FIFO method, it will be priced at the first lot's price. So these are the special transactions which occur in all situations, in whichever is the pricing method which is used, and the columns in which each of these items will be shown will remain the same. That is, materials which are returned to store is shown in the receipt column, return to vendor is shown in the issue column, shortage is shown in the issue column, surplus is shown in the receipt column. This will remain the same for all methods, but the price at which each of these items are shown will differ according to the method which you use. So in the first two cases, if the dates are mentioned, take the price of that particular date. If the dates are not mentioned, you look at that particular day's balance and price it at the first lot's price. Shortage and surplus also, here the question of dates being mentioned is not there. Look at the balance on that particular date in which the shortage or surplus arises. Then you look at the first lot and price the shortage or surplus in the first lot's price. So this is how special transactions are treated in pricing of materials and in FIFO. So in this class we dealt with FIFO method and we did one very basic problem on FIFO. In the next class we will do a more detailed problem including each of these special transactions. Okay, thank you.